$3 trillion. That is roughly the size of the bill 9 technology companies have signed up to pay, that has not yet appeared on their balance sheets. Not hidden by fraud, not buried offshore. Sitting in plain sight in the footnotes of their own filings, growing so fast that one company added nearly $500 billion of it in a single quarter. This week, the Wall Street Journal added it all up, and the bond market noticed. Today on The Current, where $3 trillion of AI promises actually live, why the safest market on Earth just hit a 25-year milestone, and how a data center in Ohio ends up inside your mortgage payment. Because this week, the AI boom stopped being just a stock story. It became an interest rate story, and you are in it whether you clicked or not. Here is the finding. The journal went through the filings of 9 companies: Meta, Alphabet, Amazon, Microsoft, Oracle, Nvidia, Broadcom, AMD, and SpaceX. Over the past year, those companies reported about $600 billion of capital spending, the number you see in headlines, the number that already frightens some investors. Then the reporters added up everything these companies have committed to pay that has not hit the books yet. Roughly $3 trillion. 5 times the reported number. For scale, that is more than the annual economic output of the United Kingdom, promised by 9 companies, mostly within the last 2 years, mostly for one purpose: artificial intelligence infrastructure. The headline capex number you have been watching is the tip. This is the iceberg. So how does $3 trillion stay off a balance sheet legally? 2 mechanics. First, leases. Under the accounting rules, a lease only lands on your balance sheet when the building starts operating. Sign a 20-year lease on a data center that finishes in 2029. And until the servers switch on, the obligation lives in a footnote. The journal found $1.2 trillion of exactly that, leases on facilities that do not operate yet. Second, purchase obligations. Contracts to buy chips, power, and equipment are commitments, not debt. So they sit in disclosure tables instead of the liability column. That is the other $1.9 trillion. Every dollar is disclosed. Almost no dollar is in the number most investors actually look at. Nobody is lying. The accounting is just built for a slower world than this one. If the size does not impress you, the speed should. Alphabet disclosed $811 billion of purchase and contractual obligations in its most recent filing. 3 months earlier, that number was $332 billion. That is nearly $500 billion of new promises in a single quarter, from one company added to the pile between 2 earnings calls. Meta is carrying about $347 billion in future lease commitments on its own. Remember, these are the companies reporting the $600 billion in visible capex. The visible number is the part they have already paid. The invisible number is the part they have merely promised, and the promises are compounding quarter over quarter, faster than almost any corporate obligation build-up in history. And this week produced a perfect specimen of how these promises get made. Nvidia signed an agreement to guarantee up to $105 billion of lease payments for OpenAI's new data center campus in Pike County, Ohio, a site built and owned by SoftBank's energy arm under a 20-year lease. If you watched our episode on the $600 billion loop, this is that story landing. The chip seller is now formally the co-signer on its biggest customer's rent. For a campus that exists to run the chip seller's chips, the first phase alone covers 4.25 gigawatts of computing, with the site designed to reach 8. Here is the accounting punchline. A guarantee is not debt either. Unless OpenAI fails to pay, that $105 billion may never touch Nvidia's balance sheet. One more giant number, filed under maybe. Promises eventually need cash, and that is where this story leaves the footnotes and enters the real world. For most of the last decade, the big tech companies barely borrowed. From 2020 to 2024, the 5 biggest hyperscalers issued about $28 billion of bonds a year. In 2025, that jumped to $121 billion. This year, they had issued roughly $244 billion by the middle of July. Amazon sold $54 billion of bonds in a single March offering, one of the largest corporate deals ever. Nvidia did $25 billion in June. Goldman Sachs now expects the group to reach $250 billion this year and $400 billion next year. The richest companies in history, the ones famous for printing cash, are now borrowing at a pace that rivals governments. The build-out has officially outrun the cash machine. Now connect the two markets, because this is the mechanic of the week. Bonds compete for the same pool of investor money. Every dollar that buys an Amazon or Meta bond, often paying more than a Treasury, is a dollar not buying government debt. When hundreds of billions of new corporate bonds flood in while the US Treasury is also borrowing record amounts, investors demand higher yields on everything to absorb it all. Bank of America's economists put it in writing this week. The AI borrowing surge is, in their words, potentially crowding out demand for long-term treasuries, and they estimate the flood of corporate debt and related issuance has pushed the 10-year yield up by roughly 1/3 of a percentage point this year. 9 companies' spending plans are now moving the price of American government money. Here is what that looks like on the scoreboard. On August 13th, the US Treasury auctioned 30-year bonds at a yield of 5.2%, the highest auction yield in 25 years. You have to go back to 2001, before the iPhone, before Facebook, before the financial crisis, to find the US government paying this much to borrow long. The 10-year yield touched 4.7% this week. And when Bloomberg asked bond analysts to explain the move, AI kept coming up next to the usual suspects of deficits and inflation. One strategist summed up the new reality in 5 words. It just touches everything. The safest, deepest, most watched market on the planet is now partly pricing the cost of building artificial intelligence. That has never been true before this year. And this is where you come in, because you probably do not own a data center, but you price off the same curve they do. The 30-year mortgage rate follows the 10-year Treasury, and it just hit 6.67%, its highest level in a year. On a $400,000 loan, 1/3 of a percentage point, the amount Bank of America pins on this year's debt flood is roughly $90 a month, over $1,000 a year, every year for 30 years. Car loans price off the same curve. Small business loans, credit card rates, the federal government's own interest bill. None of these markets asked to participate in the AI build-out. But when $3 trillion of promises starts converting into actual borrowing, everyone who borrows shares the bill. You are not watching this boom, you are co-financing it. Now the other side, because this story has won. These are not WeWorks. Microsoft, Alphabet, Meta, Amazon, and Nvidia are among the most profitable enterprises ever built, generating hundreds of billions in operating cash flow against these commitments. A commitment is not debt. Some contracts can be renegotiated or cancelled, and lease payments spread over 15 or 20 years, not one. And AI is not the only force lifting yields. Deficits are enormous, inflation has been sticky, and those alone would push long rates up. Bank of America calls AI borrowing a contributor, not the whole story. So this is not hidden fraud, and it is not a crash prediction. It is something quieter and stranger. The largest capital project in human history, financed partly in footnotes, repricing everyone's money as a side effect. Here is the asymmetry worth sitting with. If AI revenue shows up on schedule, these commitments become normal bills paid by thriving businesses, and the footnotes were early warnings of a boom that worked. But the commitments do not wait for the revenue. The leases start, the chips ship, the bonds pay coupons on schedules signed years in advance. Meanwhile, OpenAI, the customer at the center of the machine, is reportedly heading toward a $1 trillion stock market debut while losing about $14 billion a year. The spending is contractual, the payoff is a forecast, and the interest rate effect, the part that hits your mortgage, is not waiting for the answer. It is already here, in the one market nobody can ignore. Step back and you can see the structure this channel has been tracing for a month. Layer 1. Equity. Intel raised $20 billion selling shares into a hot story. Layer 2. Collateral. Wall Street is raising $500 billion against the chips themselves. And now Layer 3, the biggest and quietest. $3 trillion in commitments living in footnotes, funded by record bond floods, guaranteed by vendors, and large enough to move Treasury yields for everyone. Each layer is legal, disclosed, and individually defensible. Together, they mean the AI bet is no longer contained inside tech stocks. It is braided into rents, rates, and retirement accounts. We covered Layer 2, the 500 billion borrowed against the GPUs themselves, in a recent episode of The Current. Watch that one next, because the layers are stacking. Subscribe, and we will keep following the money.